Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. Thank you for joining us today. In today's session, we're going to be breaking down how an ETF works behind the scenes and how it provides investors with liquid access to the market. So we're going to look at bid-ask spreads and discuss with a market maker their role in this whole thing in supporting this ETF market. Just as a reminder, today we're not providing you any advice or investment recommendations. As always, today's episode is all about providing education around investing and around using ETFs for Canadian do-it-yourself investors. With me today, I have Matt Montemurro, Portfolio Manager with BMO ETFs and lead PM on our lineup of fixed income ETFs, and Jimmy Karam from BMO Capital Markets. And Jimmy is a market maker for ETFs as part of his role, and I'm thrilled to have both Matt, a portfolio manager, and Jimmy, a market maker, on today's show, as these two roles are really what supports the overall functioning of the ETF ecosystem, so to speak, and ensures liquidity within the market through their work together. So thanks for joining me. Before we get into it, just a quick reminder to check out our YouTube channel. Here you can watch any episodes that you may have missed. And as always, remember to subscribe and ring that bell. That way, every Friday, you'll be notified as we go live. So for today's 1-minute update, let's take a look here at the overall ETF marketplace. So this is a snapshot that I pulled in from a research report from ETF-GI. And what it's showing is that while there are over 1,000 ETFs in Canada, lots of ETFs in Canada, only 22 of those ETFs have assets under management greater than $2 billion. So there's many of these smaller ETFs on the market. Said another way, the top 20 ETFs by AUM in Canada account for 34% of the overall assets in Canadian ETFs. So those top 20 ETFs make up a large portion of the market. The largest ETF in Canada is BMO's very own ZSP, or BMO S&P 500 Index ETF. And what this report also shows, and what's quite interesting, is that the top 20 ETFs account for over 50% of the overall ETF trading volume. So many of these 1,000 ETFs that we have in Canada have less than 20,000 shares traded each and every day. So what we're going to do today is we're going to address the concerns that many investors have out there over these smaller or less traded ETFs in the market. Because it's really important to understand that volume traded on an ETF does not measure its liquidity. And we're going to get into more in terms of why this is as we get into our chat today. So Matt, let's back up a little bit here. I'm hoping you can give me, in the most basic sense, what do we mean when we talk about liquidity of ETFs? And what's the difference between the liquidity of an ETF versus the liquidity of a stock?
Yeah, absolutely, Erin. And let's start by talking about just that very thing, that liquidity. Liquidity is your ability to transact in a security, let's say buy or sell, quickly, efficiently, and cost effectively. When we talk about liquid assets, when transacting, you see little to no change in the asset value when the shares are transacted between counterparties. So, investing in liquid assets does remove some of the investment risk by ensuring that an investor will be able to quickly react when the market moves. So, this is why we often hear things like private equity and private credit being labeled as higher risk. And that can be generally deduced to their less liquid profile, less liquid in nature, therefore higher investment risk. So how do we compare that to stocks and bonds, and how do we compare stocks and bonds to ETFs? The big difference here is that a stock or a bond has a finite number of bonds or shares outstanding, where an ETF is an open-ended instrument that allows the ETF provider to create or redeem units as they see more or less demand. If they see more or less selling, they can create or redeem units. The subscription redemption mechanism does open up significantly more liquidity, especially to less liquid areas of the market. So for example, like the bond market, which is an over-the-counter market, i.e. it doesn't trade on an exchange, the ETF provides a much more liquid vehicle to attain access to this less liquid market. So the ETF allows investors to dip into deeper pools of liquidity when they may not see that liquidity at the surface on the exchange, i.e. there may not be a seller that is exactly matching what you're trying to buy. So in the equity market, you may need to pay a premium to be able to buy that, or you may need to wait for more sellers to come to the market. An ETF, it's unique because it can create new units and allow you to get what you need on the spot.
Perfect. And I touched on how volume is not a good indicator of liquidity, and you've talked about how ETFs are open-ended. Is that sort of why this volume is not the best indicator? Can you touch on that?
Yeah, so volume is a very, very popular indicator, and it is a good indicator of liquidity for stocks, but it's not as good an indicator of liquidity for an ETF, and that is solely because of that creation redemption mechanism. So the volume traded often can be irrelevant when you're discussing liquidity of an ETF, especially when you're talking about large orders. Since that ETF dips into that deeper pool of liquidity, so that true liquidity of the underlying asset class, that's where you should really gauge the liquidity of an ETF. And you can't just look; you have to look past volume, and you have to. The true liquidity of an ETF is that the liquidity of the underlying asset class. So let me give an example here. Let's say an ETF trades 1 share per day, and you want to buy 500 shares of, let's call it, a S&P 500 ETF. The true liquidity profile is not on that 1 share volume of the ETF, it's on the underlying S&P 500. Can you buy that dollar value in the S&P 500? And that's where the true liquidity, and that's where it's important to understand and remember. So when you're looking at the liquidity of an ETF, the underlying asset class is the true gauge of that liquidity. So let's use the S&P 500 as an example again. We see many ETF trades trade in the hundreds of millions at a single go. And an ETF may not have the average daily volume to satisfy that $100 million trade. But these are the most liquid stocks in the world. Surely the underlying S&P 500 can take $100 million coming in to buy those stocks. So therefore, the ETF ignores the volume traded on the exchange and goes to the second layer, which is the underlying liquidity of the market. And that's where the ETF market maker will create new units to fulfill the order. And that's the beauty and the benefit of using the ETF, is just that creation redemption mechanism that allows you to access liquidity of an underlying market rather than just the top level volume on the exchange.
That's great, and we're definitely going to get into that a little bit deeper as we continue to go on, but I'm glad we cleared that up. If you are looking at volume, if you're just interested to see how much that ETF traded in any given day, I just wanted to take a beat here to explain that with volume data, you also have to be aware of your source. So as you can see, these are 2 screen grabs that I pulled last week, and they show the volume of ZCN, or Canadian Composite ETF, on 2 different quote providers. Yahoo on the left and Google on the right. And what you're seeing is just basically a huge difference between the 2. On Google, it's showing twice the volume. You're probably asking why that is. Well, ETFs in Canada can actually trade across a range of exchanges. There are, I believe, 8 different exchanges in Canada last I checked. There's NEO, there's Alpha, Omega, NASDAQ, of course, the TMX, and so on. So some quote providers are only going to show the volume traded on the Toronto Stock Exchange. And that's important because in reality, they could be trading across any number of the exchanges I just mentioned. So this is just a quick reminder to beware of your volume data. If you are looking at volume, make sure that you're looking at consolidated volume across all the exchanges. So Google provides that. Another great provider is Quote Media. On Quote Media, you can actually go online and see exactly which exchanges that ETF has traded across in any given day. So just wanted to highlight that. Now, Jimmy, thanks for being here today. Jimmy, as I mentioned, is an ETF market maker with BMO Capital Markets. Of course, a great partner to us here at BMO ETFs. I'm hoping you can walk us through, Jimmy, exactly what an ETF market maker's role is in supporting the overall liquidity of an ETF.
Yes, absolutely. And first of all, thank you for having me. So really the role of a market maker is to act as a dealer for the ETF. So my role every day is to post continuous bids and offers on the exchanges for these ETFs. So the way we do that is we actually hold an inventory of ETFs, and at any point in time, we stand ready to either buy or sell the ETFs. So we're indifferent to whether a client is looking for liquidity on the bid side or on the offer side. We're always there, ready to post continuous bids and offers on all the ETFs, and that provides one of the 3 layers of liquidity to the ETF. And that's really, in summary, what we do as a market maker. Now, Matt mentioned all the different layers of liquidity in the ETF and how liquidity of the ETF works. So, I don't think I can actually top that explanation. That was a very perfect explanation of that.
Perfect. Thanks, Jimmy. And then, Matt, as you mentioned, many investors are really only aware of that sort of first line of liquidity or the natural relationship between matching buyers and sellers, which is sort of similar to what a stock's liquidity profile would be, as you spoke about. Can you go a bit deeper into what are those 2 other layers of liquidity within an ETF and explain those a little bit more for us?
Yeah, for sure. And unlike a stock and a bond, I think the 3 unique layers of liquidity of an ETF is really what makes the ETF itself special. I think the first layer being the natural liquidity between buyers and sellers on the exchange. In the last slide, you just saw, someone looking to buy, someone looking to sell, and they just meet on the exchange. That's great, but that's only the top kind of froth layer of liquidity. I think the ETF provides 2 much more deeper layers that allow market participants to access the underlying asset class in a much more liquid manner. So that second layer of liquidity is the market makers. Jimmy, who's chatting with us today. So every ETF has a designated market maker that makes continuous markets on the product throughout the day. Most liquid ETFs have several market makers that are making continuous markets throughout the day. These market makers are pricing the underlying portfolio and connect buyers and sellers, or connect directly with buyers and sellers, adding a significant layer of liquidity to the equation. So they're always there, adding a price on the bid and the offer, giving investors an extra layer to trade with. That final layer, once the market maker has bought or sold enough of a position, so Jimmy mentioned his inventory of that position, they can then reach out to myself, the ETF provider, and they can ask us to create or redeem units of that specific ETF to offset that risk. So this third layer of liquidity is where the ETF provider creates or redeems units to fulfill the demand and supply imbalance that may occur in the market. These 3 layers of liquidity are extremely additive to the liquidity profile of all ETFs, especially when you compare it to other investment instruments.
Awesome, thanks, Matt. And then Jimmy, can you dig a little deeper into that creation redemption process that Matt mentioned? How exactly is that working from your perspective, and how are you working with Matt on that? Can you walk us through sort of an example of how that works?
Yes, absolutely. It's the equivalent of an in-time creation. So, if I were to draw comparisons, let's say, like a car manufacturing company, right? So there's a secondary market for cars, and as demand sort of outweighs supply, there's a shortage of cars. So then you go in and there's a mechanism, you go into the manufacturer, you manufacture net new cars. So the same idea applies here. And there's also the flip side, which is the redemption. So let's take the fixed income market as an example. So at any point in time, The first layer of liquidity is, natural buyers and sellers of fixed income ETFs coming together and matching out. The second layer of liquidity is, let's say there's more buyers of a fixed income ETF than there are sellers. So then my inventory over time becomes shorter some of these fixed income ETFs. That's where I go and reach out to the manufacturer of the ETF or the ETF issuer, let's say BMO Gamma in this example, and I say, here's an inventory of bonds that I have that I would like to use to create some more of these ETFs to meet this demand for the ETF. So that is an example of a creation. So it's called an in-kind creation, where as a market maker, I would deliver a subset of bonds to the ETF issuer, whereby the ETF issuer uses these bonds to create the ETF, which I can then use in my inventory to continue to market make the ETF itself. And the flip side is true on the redemption side.
Right. It's a great mechanism, creates a lot of liquidity in the market. Now, I want to walk through a few myths out there. So Matt, a common myth is that if an ETF has lower volume or is smaller, that a large trade can actually move the ETF's market price. Can you walk us through why this isn't true?
So I'm the myth buster today. So this one's an excellent example of, and a kind of a follow-up on my earlier answer. Again, the true liquidity of an ETF is more representative of the underlying asset class rather than the ETF itself, whether that be volume or the size of the ETF. So, regardless if the ETF is small or how low traded volume it has, that underlying asset class liquidity is the true measure of how much maybe a large investor would be able to get done in a single day. So as an example, let's use what's on screen here, ZAG, which is our aggregate bond ETF. It's the largest fixed income ETF in Canada. While it does have large daily traded volume for trades, when you're looking at trades in the size of $100 million, the average volume isn't going to satisfy, to that demand and that need. If you used volume as an indicator, that might tell you might need to do this trade over 10 trading days, and that'd be very common to look at if you were looking at a stock, for example. Yet, if you use this trade as an example, this client was clearly able to trade intraday at a significant significant increase to the average volume and get significant size, hundreds of millions of dollars done. So how is that possible? So if you look to the underlying Canadian bond market, you know that 100 million in or out of Canadian federal, provincial, corporate bonds in a single day is well within the realm of possibility in a normal market. It's not going to be an issue for us to go out and buy federal, provincial, and corporate bonds for $100, $200 million. That's just a normal course, and that's a normal day. So when you're looking at the ETF, that liquidity profile, the fact that you can put $100 or $200 million into the market, that flows through to the ETF and should allow the ETF to be able to quote that same price intraday for size that is much, much greater than the volume is indicated. So this client was able to trade in the market, creating new units in the process, while the ETF PM, so myself, I then go into the underlying bond market and I buy bonds accordingly. So while ZAG is the largest and most liquid fixed income ETF in Canada, volume and size doesn't give you the entire story or the entire liquidity profile. So although it's a big ETF, although it has lots of volume, that also doesn't mean that you couldn't do greater size than that average volume. So, regardless if it's a large ETF or a small ETF, it's important. You really need to take one step further and look below at the underlying asset class to understand where the true liquidity is and where you may actually be able to trade.
Mm-hmm. And understanding that creation redemption mechanism is so important. Jimmy, another myth is that trading activity on an ETF can impact the underlying securities within the ETF. But in reality, this isn't the case. A market maker could have an offsetting trade, for example, but maybe you can walk us through why this isn't the case.
Yep, for sure. So to Matt's point, so when we look at the liquidity of the ETF, we discussed, the 3 layers of liquidity. So we're talking about in a way, the ETF is a liquidity aggregation tool. So you're getting additional liquidity than the underlying securities in a lot of cases. So in the case of a fixed income ETF, you are getting additional liquidity than if you were to trade the underlying securities. So that's why sometimes, to Matt's point, the traded volume in an ETF is not reflective of the liquidity. So in the same logic, the ETF is also used as a risk dispersion mechanism. So in a lot of cases, because of that additional liquidity comes the ability to trade bigger size without causing any disruptions in the underlying security because of those additional layers of liquidity. So the simplest example and the purest example is that first layer of liquidity that we discussed a few slides ago, where a buyer and a seller meet, on the market. So in that case, the risk or the ownership gets transferred from one party to the other without ever touching the underlying asset class, and that tends to be, quite frequent. So in a lot of cases, you're actually dispersed. There's a dispersion mechanism there that, in fact, actually does not even touch the underlying market. So there's no impact whatsoever, and that's both a function of that ETF tool being both a liquidity aggregation tool and a risk dispersion tool at the same time.
Perfect. That was a great explanation. And then we often talk about ETFs as an access tool, giving investors access to a lot of these harder to reach asset classes like over-the-counter securities, fixed income, preferred shares. And they do this sometimes at tighter bid-ask spreads than the underlying. How is this possible?
That's exactly it. It's it's liquidity aggregation model. So in a lot of cases, you're talking about net new participants in that asset class because it was wrapped into an ETF wrapper in a way. So more people are able to trade in that asset class. More people are able to understand the asset class. So we see more and more participation. So I would say in the past, maybe, again, I'm going to take the fixed income market as an example. So in the past 2 years, we got to an inflection point where the liquidity of the ETF on some of those larger ETFs, ZAG for example, is maybe double the liquidity of the underlying asset class. So you see that in tighter spreads, you see that in deeper execution. Same thing happens in similar asset classes such as prefs, where people have access to the ETF versus very limited access to the underlying securities. So when you put all these instruments into baskets and you make them more accessible to everyone, you get net new participation in the actual tool, which makes it a much deeper tool to use and a much better liquid instrument.
Perfect. All right. I think we have proven that ETFs are a very liquid tool for investors to use in gaining access to the market. And of course, the portfolio managers and the market makers are there to support that liquidity. Matt, are there other tips or best practices that you'd have for do-it-yourself investors to help them get sort of best execution on their trades?
Yeah, absolutely. And it's always important to know the tips and tricks to ensure you're getting best execution. I think that's a huge part of the trade, and I think it's something that concerns a lot of people. So, the first tip, I would say, the first 30 minutes, the last 30 minutes of each trading day. So let's call it from 9:30 to 10 a.m., from 3:30 to 4 p.m. They tend to be very volatile in the market, and they can lead to some pricing anomalies. So, best practice would be to avoid these times when you're looking to buy or sell your ETFs. You want to avoid excess volatility. When you are looking to get best execution, avoiding that volatility or excess volatility generally is something you want to do. Second would be always use a limit order. This is something that I preach every single day. While we do have continuous markets on all of our products via Jimmy and the market makers, using a limit order is a way that you can protect yourself. You set the price, you set your limit, and you will maintain your protection. A market order opens you up for things that would cause significant downside, whether it be human error, a flash crash type event, or just extreme volatility in the market that you didn't foresee. Limit orders will be your best friend in these type of cases, and they'll make sure that you're protected on the downside. Finally, think about the underlying market. If you're looking at a US stock market ETF, an S&P 500 ETF, is the market open? For example, July 4th, Canadian markets are open. US market is closed. That means that if you're looking to buy a US underlying ETF on July 4th, the market makers who are looking to price it basically have to guess on the value of those underlying securities. That's never going to lead to the most optimal outcome for you. So trade when the underlying market is open, whether it be holidays like July 4th, or if it's trading hours. So for example, if you're looking at something like trading a European stock ETF, trade in the morning while London and the European markets are open. That allows the market makers better visibility into the underlying securities and can give you better access and better pricing. So those are just some 3 tips that I always like to identify for investors, and I think it's very important when you're looking at trying to get best execution when you're doing it yourself.
For sure, and these are things that advisors out there always abide by, so it's good that we are sharing these with the do-it-yourself investors out there too. All right, thank you both for that. I do want to turn just for the last couple minutes here to 2 audience questions that came in this week. As always, you can submit these questions either on etfmarketinsights.com or on our weekly email that goes out. And we love getting your questions, so keep them coming. This one, Matt, I will send your way. What is the impact to markets as a result of the central bank's decision this week to raise rates again?
Yeah, so we had the Bank of Canada announcement yesterday, and they continued on their path of higher rates by raising the overnight rate by another 50 basis points to 4.25%. So the fact that they raised wasn't necessarily a surprise, but they were more aggressive and hawkish than the market had anticipated. We were all kind of expecting about 25 basis points, so they went 50 instead. Normally this might be seen negatively by the market, but after some short volatility, kind of right after that 10 a.m. period, the verbiage of their announcement was quite telling. As everyone started to go into the details, the Bank of Canada has seemed to pivot their messaging. So while they're still focusing on inflation and that higher rates are needed to ensure that inflation doesn't become sticky and ingrained, they did indicate that future rate hikes will be data dependent. And this is kind of going back to what we used to see and used to hear from the Bank of Canada when they were talking about rate decisions prior to this most recent hiking cycle. So in past meetings this year, they have always been pretty firm and indicated that it was basically an assurance that more hikes were needed. This pivot, this change in tone by the Bank of Canada, that they're not saying that more hikes will be needed, but they're going to monitor the economic landscape and decide as be, likely means that we are nearing the end of the hiking cycle, and that we're going to the Bank of Canada is going to start to let economic data create the path forward. I think overall this is probably a positive sign to say that we're nearing the peak. We're not there yet. We could still see rate hikes, but we are nearing kind of that prolonged period of hikes. We're nearing the peak, and I think that holding pattern for higher rates for longer, I think that's something that we should expect for 2023. But I think one of the positives is that if we're nearing a peak, I think that's positive for markets. That gives some stability to markets, and I think that's something for investors to look forward to as we move into 2023.
Excellent, thanks, Matt. All right, and the next question, a tax-focused one. When do I get the tax breakdown, dividends versus cap gains versus interest for my ETFs? So I could take that one. Generally, the ETF providers are going to send that out mid-February, and they'll post it on their website, of course, so you can download that. And then I will just give a shout out. We have a really good piece on etfmarketinsights.com, a tax FAQ under the Education Center, with all of these timelines and what to expect in tax season. So if you haven't downloaded that, I would suggest you grab a copy. All right, so that caps off another great week of ETF Market Insights. Thanks, Matt and Jimmy, for an excellent discussion today. I think this was a good session to help clear up some of the mystery, if you will, in terms of how an ETF operates behind the scenes. We always talk about how these are such a great access tool, giving investors liquidity, but don't often spend a ton of time explaining really how that works. So hopefully everybody found that useful. Next week, we'll be back, same place, same time, and it will be our last session of 2022. So next week, we're going to be focusing all around the central bank's decision, their moves this year, what's expected for next year, how these rate increases are going to impact the market and our portfolios going forward, and some ideas to help position your portfolios. So Alfred Lee, our investment strategist and portfolio manager with BMO ETFs, will be back to discuss this hot topic. I hope you'll join us then. Thanks again, Matt and Jimmy. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.